Good afternoon, everyone, and welcome. We'll just get started in a few minutes. We still have a few more participants joining, so just be patient with us and we'll start in a minute or two. Thank you. All right, we'll go ahead and get started. Welcome to this afternoon's webinar, Improving Your Business and Business's Financial Health, Understanding and Managing Your Inventory. My name is Malini Krishna. I am a member of the Business Advisory team here at Pursuit. For those of you who are new to our programming, Pursuit is a community-focused alternative lender. Our goal is to ensure that our clients not only have access to the capital they need through our loan programs, but also that they have the strategic guidance and business expertise to thrive through our advisory services. Today, we're going to review a key business function, inventory management, from two perspectives. The operations perspective, which is really about how does your business use, manage, buy, sell inventory, and from our lender perspective, where we will cover what a lender looks at when they look at your financial statements in assessing your potential for a loan, as well as your financial health of your business based on some of the metrics you have on those financial statements. So our goal by the end of this webinar is that you will understand the best practices to understand, manage, and track your inventory, whether that's, assessing purchase orders for holidays or deciding what to do if you have excess inventory or other related matters. How inventory is a key driver to your profitability, especially if you had to transition your business this year, whether that's from brick and mortar or if you've had more online or wholesale orders as a result of the current economic state and public health issues. Finally, we will help you uncover what your inventory practices reveal to a lender and what positions you best when you're applying for a loan or have questions about specific things regarding inventory on your financial statements from a loan team. Today, I am joined by two talented and well-versed experts, Angela Pearson from the Acceleration Project and Dave Hanold, the Chief Lending Officer of Pursuit's Community Finance Portfolio. Let me just start with a few brief words about them. As Chief Lending Officer, Dave oversees all loans and staff training, lending operations for the Community Finance Portfolio, which includes our SMART and microloan products. He has been with the company for over 9 years, and prior to managing the Community Finance Portfolio, he led Pursuit's US SBA 7A lending activity in New York City. As a colleague, I am most grateful that he is always willing to work with our clients to help them understand what their financials communicate to the underwriting team. So welcome, Dave. Thank you for being here. Next, we have Angela Pearson. Angela's professional experience in planning, production, and inventory management for wholesale fashion companies. She's been doing that for a long time, and we're very grateful that she's here. She served as Vice President of Production and Sourcing at 9 West and VP of Demand Planning at Polaris. I believe that's correct. Angela built and trained teams and supervised processes to keep inventory flowing in a timely manner. Her strengths include the ability to listen openly, prioritize tasks, and to partner with key constituents. She currently works with the Acceleration Project, which is a female-founded, female-led consulting company dedicated to helping local economies and by channeling vanilla talent into various companies. They serve underserved small businesses, particularly women and minority owned business enterprises and various different types of organizations similarly structured by offering a range of advisory services such as deep engagements with individual businesses to scale programs, and they do this through webinars and workshops. They also have a proprietary results-driven process to provide advice and tools and action plans to customize meet the needs of various different clients. They also are a valuable partner to Pursuit, and they have worked with a number of our SMART and microloan clients on projects including financial planning, marketing, strategic planning, operations, and e-commerce enablement. So thank you for being here, Angela, and welcome.
Thank you. I'm very happy to be here.
Great. So let's just dive right in. The reason we wanted to tackle this broad topic of inventory is that we noticed that many of our clients have had to make many changes this year in what they're selling and how they're selling. Maybe they can't fully open their brick and mortar locations, or they've uncovered new potential by selling online, either through their own marketing channels or on aggregator platforms. So what they're buying and what they're selling have had to adjust to meet both client needs and new opportunities through these various selling channels. But inventory is something a little bit more basic than that. Angela, can you just start by defining what is inventory?
Absolutely. I wanted to start by saying chances are that if you're operating a business, you have some interaction with inventory. And ideally, we're hoping that that interaction involves some level of understanding your stock position, understanding your best performers and maybe your not so stellar performers, and what your strategy and plan is for that inventory. So, really recognizing that the cash flow is very key in an operation, and it starts and ends with inventory sometimes. And the strong management of inventory is very important to the financial strength. So just a simple definition of inventory is it's an array of finished goods used in production held by a company. Inventory is classified as a current asset on a company's balance sheet and serves as a buffer between manufacturing and order fulfillment. And that's your textbook definition. But when you think about it, inventory is anything from raw material to work in progress, or what we call WIP, or your finished goods. It's anything, all the components that go into generating revenue.
Great. And we often think of inventory just in terms of having the actual products to sell, but it doesn't necessarily mean the more you have, the more you sell. Can you talk a little bit about how inventory can impact profitability, or some of the metrics that kind of impact the bottom line of a company, Angela?
Absolutely. You don't want to have your inventory, and my experience is when your inventory is tied up, or your cash, I should say, is tied up on an inventory spend, clogged by poor performers or paying for space to store inventory, it's going to affect your bottom line. So, well-managed inventory definitely has a strong relationship with the profitability of an organization and the results. So you want to spend some time. And inventory is a huge asset, but also if it's not well managed, it can be a huge liability and it can really create financial crisis. So you really want to spend some time understanding inventory and applying some best practices and metrics that would help you achieve that goal.
Can you talk about some of those best practices?
Absolutely, yes. Well, when we look at, the first thing I would say is that in my opinion, what I've experienced is that it all begins with a strong forecast. So if you have built in, what I used to use is an open to buy, basically run it like a checkbook. So, you apply your forecasts, you look at your last year history, you apply current metrics and current volatility and trends that apply, and you say, how much inventory do I really need to support my business? And when you determine what that number is, then you want to try to keep within that and don't overspend. So sort of like not putting your checkbook into overdraft, right? Like you don't want to spend more than you think you can support. And some of these things to look at, I mean, it's not easy because none of us have a crystal ball. We don't know what inventory is going to perform. So when you go to make these decisions and you say, what am I going to buy? Like, I know how much I need to buy, but what is the content going to look like? So you might want to look at your category mix, at what you currently have on hand, and say, of what I have in inventory, what's selling? Do I have enough of those best sellers? What's not selling? And what am I doing with that? Let me get that out of my inventory, because if I don't purge, I don't make enough money to bring in and allow room for the better sellers, right? So you want to try to keep auditing and looking at that as often as you can. One of the things I find is helpful is editing the number of SKUs. If you keep your SKUs tight, when you plan your assortment and what you buy, it's not as tricky, right? The more colors, the more sizes, the more assortment, the more you have to spread that dollar. So keeping it really tight is helpful. I found that to be important. And this is a good place to apply the 80-20 rule, knowing that 80% of the sales are going to be generated from 20% of the stock. So there's no need for all that extra stock, right? Really, in theory. Understanding the life cycle of the product. knowing when you can get back into stock. If you have something and it's sold out and you need to recover, how quickly can you get into it? And that comes from a relationship with the supplier. You know, sometimes knowing the lead times. I mean, I had a situation from a personal experience in footwear where we were sourcing shoes out of Italy, and you had to remember that they shut down in August. They have a complete month where they're not shipping shoes, they're not producing, they're not working. So if you haven't planned ahead for that, and that could be huge. So very important to keep in mind the special attributes that you need to know, and those lead times really are important because you need the opportunity to recover, or you'll be out of sales, right? So that's important. Identifying outlets, having relationships with different people that give you an opportunity to purge your inventory. So if there's someone that is a liquidator perhaps, or getting creative with different methods, it's important to identify that because you want to get out of a bind when you have too much inventory and you have nowhere to go with it. And then knowing your costs associated with holding inventory, specifically during holiday times or certain peak times, those costs can be driven up. And if you have a lot of inventory, you're going to be paying costs on not producing any revenue, and it's really not helpful. And then also really important today is having that relationship knowledge of how e-commerce is impacting businesses. That's key. And the main thing to recognize is all of these factors, and there are others, they all point to one thing, and that's pretty much the profitability of a company. How well you manage these things really will have an impact on that.
Can you just comment a little bit? One of the things that you really shared with us is that, as you're looking at all of these things, a lot of our companies really want to grow, but growing doesn't necessarily mean that you're going to mean that you're profitable. So what are some of the tools that people can kind of look at in terms of, or our thought processes they should look at in terms of inventory, just because they do want to get bigger, or they do see, my online sales are growing exponentially?
Mm-hmm. Well, I think one good place to always start is really, like I had said earlier, not to sound redundant, but having a good handle on what you have currently on hand, right? So, and sometimes that takes up to, like, when you say what tools, you might want to use something like a simple Excel spreadsheet. I mean, there's not a lot of cost behind that. You can do something simply that will allow you to monitor the flow. But very importantly is to really look at it regularly, do some strong audits on how your business is performing and adjusting accordingly on those regular checks. So, you might use a simple spreadsheet, but if that simple spreadsheet becomes too simplistic and you need something more robust, there are plenty of software programs out there that can help support that. And at TAP, we've done some review and analysis of some of these programs that have helped us, steer some businesses in that direction. Knowing what you have outstanding out in orders that have to come in, that's important. What else? I'm trying to think. I think those are the key.
Okay, you talked also about, we've had a few situations where some clients have had excess inventory here. What do you recommend is like a best practice? Do you think you should be like combining SKUs, or should we go straight to a liquidator, or those kinds of things? Is there anything that's like a good practice that you can recommend if someone has excess inventory on the books right now?
Absolutely. Liquidator is always a go-to, but you want to really be careful of the brand image. That can sometimes tarnish, depending on your brand integrity, where you want to sell these goods. So that's important to keep in view. My experience was, like, we had high-end brands that you never would want to send to a really low-end liquidator that's going to sort of really and tarnish, I guess, the value for future. But it's really going to depend. That's one thing. We've looked at, there's some third-party websites that you can use. You can get creative with, like, bundling and pairing things. So, like, if you have a really great seller and you might want to give away something or discount something that's not, to help push those, through. Those are some of the popular ones. You might want to ask the supplier to take goods back. That, sometimes will work. It depends. That's something that's been put on the table. There are pop-up shops, that you can do, where it's not a huge commitment to rent a location, but you can do it, like, for a short, limited time. work on that to bring goods in and purge quickly. So those are some of the key ones.
I should also pause and say, if any of our audience has any questions, please feel free to type that into the questions and chat box, and we'll try to get to them as much as possible. I do have one more question, which is that, you know, a lot of our clients talk about how often should we manage inventory. Actually, we've had a number of clients we've worked with whose sales are going through the roof now. Online sales have been really good, and, you know, we're seeing exponential growth. So what do you think is a good practice in terms of reviewing your inventory and how often you should do that?
That's a great question. I think that the answer really depends on the type of business. So there's some businesses that lend themselves to a weekly review. I mean, let's say something like a restaurant, right, with perishables and things that need to be replenished often. That should be very often. And then you have businesses that are more that have more longevity, let's say, and those you might want to look at on a monthly basis or a quarterly basis, and some of them yearly. But whatever the pattern that is identified, it's really like it needs to be consistent, in my opinion, and not something that you do once and then sort of get lax about, because things change and the volatility of the market will impact what's happening, and you want to use those trends to adjust accordingly. I mean, that was my experience, where you were like, oh, I didn't see that coming, or you didn't take something into account. And whatever that pattern or that method of timing that you determine, I think the best is that it becomes a consistent best practice, and then rinse and repeat, try it again and do it again and again and keep it up.
Before I hand it over to Dave, you've talked about how it's important to communicate within your company about inventory. Can you just talk about the relationships you've had across the different areas of different companies you've worked at, and what that information has been helpful for, whether it's someone who's on the financial side or on the selling side or those kinds of things?
Sure. The relationships really spread. They started with sales and the sales team, right? And for me, it was always a constant communication with what was happening out in the selling field, because that was the forefront with the actual audience, and they're the buyers. Then it was really an accountability to the finance and accounting teams, because I was constantly being asked about my inventory, and if it wasn't tight and we were overspending, I was impacting the bottom line. So I was held accountable for that, and that was important. But a really close relationship with the product development team, because they were the ones developing the SKUs and making the the assortment so big that I couldn't buy it. I didn't have enough knowledge, let's say, without the right direction. When you have that many, it's like, what are the top 3 colors? I don't need 17. So applying it to fashion in my experience. But it really had to spread, and then conversations with the distribution center, because it's really keeping in touch with, are we running out of space and location, and what do we need to do? So you need to make room to bring in your new receipts. So I really touched a lot of arms within the company, and that communication needed to be going both ways. And then financial planning, because a lot of line development and planning went into that as well.
Great, that's actually a good segue into Dave. We've had a number of questions about, what does it mean that I have inventory on my balance sheet? How does that impact it? From your perspective, Angela touched about how important it was to communicate it from a financial piece. And really what we're asking you is, you receive financial statements from companies all the time. What are you looking for, and what are sort of either red flags or green flags on financial statements that you see from your side?
Sure. So let's skip ahead a slide or two. So the questions that I'm trying to answer for the audience are, what does a lender look for generally in terms of inventory on hand and growth and potential red flags? So we're going to go over some sample financials of an imaginary company, and I'll tell you what a first pass looks like at those financials, and a couple key ratios that a lender might consider, as well as answering the question, if this imaginary company were asking for a loan, what red flags does this example present, and how could they be relatable for another business maybe calling in for this webinar? So. And then finally, we'll address the issue of inventory as collateral, or rather that topic rather than issue. So This
Great.
imaginary company has submitted to us as a lender 3 years of financials. Let's assume that 2020 is a 6-month or 12-month statement. Doesn't matter, but this is at least 2 years of tax returns and financial statements. And you can see at first glance that the company has grown their revenues pretty substantially, from $200,000 in 2018 to $250,000 in 2019 to $300,000 in 2020. Also, first off, Melanie, is my audio okay coming through clearly?
Yeah, we can hear you, Dave. Great.
The gross profit, however, has declined from 120,000 down to 110 the following year and down to 100,000 in 2020. So that right there is already a warning sign or a red flag to a lender, because even as revenues go up, the amount that each sale is yielding to the owner is less and less year over year.
And this is
Operating
kind of speaks to what
expenses.
Angelo, yeah, this was talking about what Angelo was saying, you know, not just because you're growing doesn't mean that's good for your bottom line.
Yeah, and when we hear the term growth, most commonly business owners think of growth only as a top line consideration. And one key takeaway that I'd love for the audience to leave with is growth to a lender can be much different than simply top line revenue. That is certainly part of the consideration, but even more importantly is gross profit, net income, and at the end of the day, balance sheet growth. So in this example, the bottom line for this company has actually worsened over time. 20,000 to 10,000 to 0. And a lender, when we're assessing repayment ability, any lender in the world will consider bottom line net income as the primary repayment source. That's what is referred to as business cash flow in almost every assessment of a small business lender. Let's go to the next slide. When a lender takes in a few financial statements and tax returns, they're usually using some kind of software or Excel program that spits out some ratios to inform how healthy the company's inventory might be and how quickly that company is selling through their inventory. In 2018, this company has a 2.5 inventory turnover. That essentially means they sold through an entire stock worth 2.5 times. And at the year end 2018, they had 73 days of inventory sales equivalent on hand. That particular measure is a ratio derived from the year ending inventory level divided by the 12-month cost of goods sold number multiplied by 365 days of the year. Now those inputs, I wouldn't expect anybody or want anybody to really remember, but what this tells a lender and someone looking at a sheet like this is this company has about 2.5 months worth of inventory on hand, meaning if they did not buy $1 worth of inventory, they could sell for just over 70 days on their existing stock. This also carries over the gross margins that we talked about on the previous slide. Gross margins are how much a business owner is yielding on each sale. So if they're selling a product for $1, in 2018 they're making 60 cents before rent, utilities, insurance, and things like that. Whereas in 2020, if they sold $1 worth of inventory, they were only making 33 cents. So again, we see that represented here as a ratio, that declining level of gross margin and gross profit. To show these ratios, inventory turn and days inventory, you can see that those are inverse relationships. As the inventory turn goes down, the days inventory goes up. That would tell a lender that they're actually selling through a bit slower in 2020 than they were in 2018. They have more days worth of stuff in 2020 than they did in 2018. So this is another level of a red flag. Not only do we see declining gross profit, but it seems like this company may have over-invested in inventory or maybe invested into low quality inventory that is not moving out of their warehouse at a fast enough speed to make them meaningful amounts of money. Or maybe they've invested in inventory that they're not able to mark up at the same level they were in 2018. And it's common for a business owner that we look at to have some initial success in a relatively small number of product lines. If we're going to use the example of a fashion company, since that's Angela's area of expertise, perhaps a company comes and they have developed a great niche as a jeans designer and wholesaler. And then in 2019 and 2020, they've expanded into shoes or socks or shirts, but they're not investing into inventory with the same knowledge or markup ability as they were in 2018 when they maybe just sold jeans. So by expanding into SKUs, potentially, that weren't as profitable as their flagship product in 2018, they've made their financial picture much worse. Even though they've grown revenues, the inventory isn't selling for as much as it used to, and it might be selling slower than it used to. So let's move on to the next slide. And so a lender's perspective focuses both on a profit loss statement and a balance sheet. It's easier, I think, for most folks in the small business ownership world to comprehend and have some initial intuitive understanding of a profit loss statement. Balance sheets tend to be both more work and more cost to compile in the first place, and perhaps more knowledge to understand and inform a small business owner. But it's important to not neglect the balance sheet because it is as informative and sometimes more informative to a lender than simply a profit loss statement. And the way I make these things a little bit more relatable is by saying every household, you as an individual, every single person has both a profit loss statement and a balance sheet. The profit loss statement is your income less your expenses. So if you have, if you're, again, using an example of an individual, you have a salary and then your expenses are rents, maybe a monthly car lease payment and food and movie tickets and the things that you spend your money on, those are expenses. And at the end of the day, you have some level of potentially a personal household excess, which is maybe equivalent to a business profit. But every individual and household also has a balance sheet, what you own and what you owe. A typical household might have some cash, maybe a retirement account, maybe a house, maybe a car, maybe retirement holdings. Those are your household assets. Your household liabilities might be student debt, credit cards, car loans, household loans, student loans, if I didn't mention those. Your business is the same. And small businesses often aren't required to compile a balance sheet for their IRS tax return, but that doesn't mean you shouldn't be able to do so for your lender. Some small businesses will only file a profit loss statement on their Schedule C, and that is legal and all good in the eyes of the IRS, but it does not help a lender understand your business's assets and liabilities. Without a balance sheet, those things can't be comprehended. So that's just the importance of knowing what a balance sheet is and why you should compile one and why you should understand.
And Dave, to the point is that you also, as a small business owner, if we're following some of the practices that Angela talked about, you have some of this information already to compile, correct?
Absolutely.
So like Angela talked about current assets, and as an inventory is a current asset. And so if you know what your inventory levels are and you know some basic information, you can sort of formulate a balance sheet on your own. So
absolutely. Good inventory management is probably a necessity and a prerequisite to an accurate and good, well-prepared balance sheet. So this particular balance sheet is, again, assets on the top, liabilities on the bottom. And this business shows that while they have shown, in a sense, some growth, total assets have increased, we see a strong centricity to their inventory. In 2018, they had cash of $10,000, accounts receivable of $20,000, and $16,000 in inventory. And then in 2020, the cash and receivables as added together has gone up from $30,000 in 2018 to $40,000 in 2020. Inventory has gone up about 5x, from 16,000 to 70,000. And this is correlating and corresponds with all those other ratios. They have a lot of inventory on hand relative to other measures, relative to other financial measures, such as sales, such as gross margin, such as cost of goods sold. I look at this balance sheet and think, again, this is yet another sign that perhaps they've overinvested into inventory, or perhaps invested into bad inventory. So do you have any follow-up topics that you wanted me to touch upon here, Melanie?
So I think the other thing that we also want to sort of highlight on this balance sheet is this was an interesting one based on a company we've worked with in the past, is that you see that there's both this idea that they're keeping a lot of inventory on hand, but it also reflects that it has a diminished capacity for them to pay off their liabilities, as you can see with the total equity, right? You know, one of the things that we are both balancing on that balance sheet is this asset, whether in this case you spotted sort of, hey, there's something going on with the inventory. They keep having more and more and more every year. But their liabilities, as you can see, even though they're sort of trying to manage what they have to pay in terms of credit card debt or all of those things, and they are staying current on any loans they have, which is a great practice, their overall total equity is sort of shifting, which suggests something else. If you could talk about.
Sure. If the equity year over year here is improving, but we know from the profit loss statement 2 slides prior that net income did not increase. Now, equity is typically an inclusion of both retained earnings, profits earned over time and kept inside the business, as well as any owner equity that has gone into the business as well. So a business that starts with $0 on hand might make $10,000 in year 1, and then the owner might put in an additional $10,000. If all of that stays in the business and is retained, their year-end equity begins perhaps at 0 and ends at $20,000. In this case, we see equity increasing from 36 to 42 to almost $55,000, but we know that profits have not increased, and in fact, profits went to 0 in 2019 and 2020. What that tells us is the only way equity could have possibly increased is because the owner had to put in more money to make up that gap. If the company is not profitable and retaining those profits, the ownership has to make up the gap somehow. And that is the only reason why on this balance sheet, equity is increasing. It's not because of increased profitability.
I'm just going to give it a little pause here, Dave, because I do have a question here. Angela, this kind of brings up an issue that we've heard about, which is that if you saw this, where you saw that you were working with a client and their inventory was going through the roof, what would be your first piece of advice for them? Like, is it necessarily bad inventory or too much inventory? How could they start with that process if this is what it's revealing?
Right, so that's a great question. What you'd want to start with looking at the content of the inventory on hand. And really understand what it's made up of. And you know, a lot of times what I've seen happen is that companies keep bringing more in and they want to buy newness and bring that in, but they really don't hold a lot of regard sometimes for what's already there. And as you see, it just accumulates, right? So you're bringing in new receipts on top of what you have. So the first thing I would say is let's look at the content of what you have and let's determine on site, what is it working for you? Is it, if it's not moving and it's a slow, you're better off taking, you know, biting the bullet, if you would, and just getting rid of it. You may take a hit on the cost and the selling cost, but it's better to get it out of your inventory because the holding costs can be sometimes greater than the hit you take on marking down those goods. So that would be the first, you know, advice. Then you want to look at what you have in the pipeline and you want to determine, do you really need it? Because you've committed to this inventory, and if you don't have a selling strategy for that inventory, it will just continue to, you know, tie up your dollars. So looking at that and then deciding maybe this is a great opportunity to perhaps cancel before the goods arrive, because you might be able, if you catch it before the goods are finished, there could be an opportunity to use the components on future and not take that inventory hit. So there's a few ways to peel that back, but starting with what you have is always the first thing, because you own it. It's yours, it's in your possession, and you need to account for it in some way.
Great, thank you. Dave, this also asked me, had this question asked by a number of clients. If your inventory keeps growing, isn't it an asset you can lend off of, like collateral?
Yes and no. Inventory is an asset, but it is rare that lenders will consider it high quality collateral to lend against. There are instances of that being the case if you were to research things like asset-based lending, or sometimes factoring can lend against inventory, but that is typically extremely costly. And the reason is because inventory is not a high value piece of collateral for a lender, because it can move and devalue so quickly. A lender is not going to be as able as a business owner to sell that inventory with the same efficiency or for the same value. So any asset that a lender considers as collateral has what we would call a discounted value. We don't expect, if any lender were to lend against a personal or commercial residence, we don't expect to liquidate, if that comes to pass, that asset at the full market value. It's some kind of auction process for any kind of asset in the unfortunate and sometimes unlikely event of collateral liquidation. In the case of inventory, it is perhaps the lowest value asset that a lender could lend against, and sometimes discounted as much as 90% of what a business owner might value it at on their balance sheet. We might assume no more than 10% of every dollar's worth of inventory could be realized out of some kind of collateral liquidation. But to most small business lenders, it is not extremely high quality collateral.
So I think that's important. If people talk about their future growth, they can't really leverage off of that. What would be your advice for, if you were to you've talked to some of our clients who might be in similar situations, what was your perspective and advice on how to move forward if this is the balance sheet and P&L you were given?
This application would most likely end up being declined because their profitability declined from $20,000 in profit, which has some ability to repay a loan, certainly, to perhaps 10,000 in 2019, I can't remember, but it was certainly zero in 2020. And to see zero profits, well, revenues are increasing, shows us two competing trends, but the most important one is the decline to profitability. We would be extremely nervous about lending to this applicant, especially if they said, I need funds for inventory, because our concern would be the last couple of years of inventory investment haven't yielded enough profits. So this would probably be a decline. And if I were to offer advice to this example business owner, it would be to reevaluate what methods were working in 2018. In that year, I would assume that there were fewer product SKUs, probably selling at a higher margin, and potentially at lower sales volume orders. A common scenario that our clients come to us with is, I have been successful selling to a small number of local retailers. Sometimes it's food and food manufacturers selling to their local Whole Foods or regional independent grocery stores. And they might say, I want to get picked up by Target. I've got interest from Target and they want to put me into 300 stores all up and down the East Coast. That might be the right move for that business, but not if the margins decrease so much as to lower or sometimes eliminate profitability. In the case of perhaps a fashion business, a business that has some small boutique relationships, they're selling to 30 small customer-facing retailers in perhaps New York City area. That's fairly common for our clients. And then they say, I've got the potential to get picked up by J. Crew. I've got an order in from J. Crew or Banana Republic or some larger designer and customer-facing retailer. That could be great, but not if it involves investing into inventory that might not sell at enough of a margin to maintain profits and maintain a healthy balance sheet. So I don't want the takeaway to be spending on inventory is bad. Dave said it was bad. We're encouraging you to think strategically about how and when you invest into inventory, because simply doing it just to do it is not necessarily the right thing. You want to invest into inventory when you're confident in your margins, confident that what you are buying will then sell at a level you can predict and maintain profitability on, and then reinvest that into your own balance sheet. You reinvest the profits from your inventory, and potentially next year you don't need a loan, or you need less of a loan.
That's actually really helpful. I'm really mindful of time, but Angela, I just have this one question here. To sort of Dave's point of new opportunities are not always the best for the bottom line. What advice would you give to many of our small businesses are seeing a lot of expansion in online stores and seeing a lot of potential in various different aggregator platforms to sell their products. What would be your perspective on that in terms of having enough product to sell or managing the process, and really like transforming that process of just looking at these are just the finished goods that I can sell, but like what are the margin structures?
Sure. I think important to look at and very realistically the forecast. So in looking at any kind of opportunity with a retail partner is really getting their commitment and sort of hand-holding of, you know, what does this mean for you in terms of volume and margin? Like, where are you going to sell the goods? At what price do you see these goods going out the door? And that's very, it plays into, again, going back to making sure that the forecasts are thoughtful, because that's going to tie into your open to buy, right? You need X amount to support that sales volume, and that's the amount that you would buy, and also at what margin are you buying it, because then that will play in. So it really does go hand in hand looking at it. You don't want to close the door to that opportunity, but to Dave's point, it needs to make sense and make financial sense for the company when you make a commitment. But also it does need to be communicated that it's a give and take. So you need to know where they're selling it and how much they plan to sell, and then roll those into your numbers.
Okay, and I'll just end here with Dave. A question we have is, if there's been a blip, so it's been a change just for this year, does that make or break a story? Sorry, we can't hear you, Dave.
I think I'm off mute now.
Yeah.
We are capable of understanding in our institution one-time events. Sometimes we've heard stories of shipments being lost in transit, whether it's on a boat or on a plane or mistreated by a supplier and damaged. We can understand when there are extenuating circumstances and hear your narrative and consider that as part of the lending decision. So if you can have this knowledge about your inventory and be able to explain how your financials represent perhaps a one-time non-recurring event, be prepared to explain that to your lender, because a good lender will listen. We like to think that we listen to those stories and can take those into account. But the only way we can take it into account is if the business owner does have knowledge of how that inventory is represented on their financial statements.
Great. Well, I will end it there. Thank you for both for being here and offering your excellent expertise on here. We really hope that this will help you see that there is a component of the business that is both important operationally, but also financially. We will have recordings and follow-up articles on this topic. And of course, if you are a Pursuit client, we encourage you to reach out to your rep, and we can have more information on both TAP, the acceleration project that Angela is part of, as well as our team in business advisory. And I want to thank everyone for attending here. Thank you for your questions and your thoughtful comments back from our presenters here today. And thank you so much, and have a good day.
Thank you.